Today, we're going to unpack one of the most powerful and honestly most misunderstood forces in all of modern finance. It's a story of incredible innovation, for sure, but also of absolutely catastrophic risk. So let me just ask you this. What single financial instrument out there has the power to both stabilize entire industries and at the same time threaten the entire global economy? Well, the answer is way more common and a lot more complex than you probably think.
They're called derivatives. And, while the name might sound a little technical, their impact is, well, it's everywhere. They are the invisible architecture behind literally trillions of dollars of global trade and investment. They shape everything from the price of the gold in your jewelry to the cost of your mortgage.
So, what in the world is a derivative? The clue is right there in the name. It's a financial contract, and its value is derived from something else, what we call an underlying asset. Just think of it this way. It's not the actual thing itself, but a contract about the thing. It could be about the future price of gold, the exchange rate of the euro, or the performance of a stock. Now, derivatives come in two main flavors. Over on the left, you've got your futures contract. Think of that like a locked-in handshake deal. It is a binding obligation. You are locked in to buy or sell at a set price in the future, period. But on the right, you see an option. This gives you the right to make a deal, but not the obligation. It's a choice. And believe me, this difference between a firm commitment and a flexible choice, it's absolutely everything. So let's look at the first edge of that sword we talked about. This is how derivatives act as a powerful shield. This is what they were designed for, their incredibly useful purpose, managing risk. Honestly, the best way to think about this is like financial insurance. The fancy term is hedging, and it's basically a strategy companies use to protect themselves from all the uncertainty out there. I mean, if your business depends on the price of something, you don't want to be at the mercy of wild market swings. You want stability, right? So how does this actually work in the real world? Okay, imagine you run a gold mine. You know you're going to have tons of gold to sell next year, but you have no earthly idea what the price will be. So you use a futures contract to lock in a sales price today. Now, if the market price for gold completely collapses next year, it doesn't matter to you. Your profit is protected. You've basically traded the possibility of a huge upside for the certainty of avoiding a disaster. Smart, right? But here's the thing. Every shield can be used as a weapon. So let's flip to the other side of the story and see how these exact same tools can become incredibly dangerous. This is the sword. Using derivatives to take massive bets. And this is the crucial point, so listen up. The very same contract a gold miner uses for safety can be used by someone else for pure speculation. They aren't trying to protect a business. They are simply betting on which way a price is going to move. It's a complete 180 in intention, from managing risk to jumping headfirst into it. And what makes these bets so potent? What's the secret ingredient? It's one word: leverage. Leverage is the great amplifier. It's what turns a tiny little price movement into a massive gain, or a completely catastrophic loss. Let's make this real, because the numbers are just staggering. With a gold futures contract, a speculator might put down just $6,000, but that tiny deposit gives them control over $125,000 worth of gold. Just think about that ratio for a second. A tiny price swing can double their money, or completely wipe them out, leaving them deep, deep in debt. That's the power and the peril of leverage. So, what happens when these highly leveraged bets go wrong? Well, as you can imagine, the history of finance is basically littered with the wreckage. This quote, it really gets to the human heart of the problem. That line between hedging and speculating, it can get really, really blurry. A trader who is hired to protect the company can start making bets on the side. And the results? Well, you see it right there. Disastrous. And here's the Hall of Fame, or maybe the Hall of Shame. Long-Term Capital Management, a hedge fund run by actual Nobel Prize winners, lost over $4 billion and almost took down the entire financial system. In Orange County, a treasurer's bets on interest rates bankrupted a wealthy community, putting public services at risk. At Societe Generale, a single trader racked up billions in hidden losses. The pattern is always the same: massive leverage, unchecked speculation, and then financial ruin. Now, these incredibly painful experiences, they weren't for nothing. They taught the financial world some critical, hard-won lessons about how to manage these incredibly powerful tools. So what did we learn? Okay, first, you need firm, clear risk limits that are checked every single day. Second, and this is a big one, you have to separate your departments. The traders in the front office cannot be in charge of the risk managers in the middle office or the accountants in the back office. You have to build walls. You also have to watch for that dangerous switch from a careful hedger to a rogue speculator. And maybe most importantly, you gotta fix the incentives so bonuses don't just encourage people to take huge, hidden risks for a quick payout.
Which leaves us here. Look, we can't put this genie back in the bottle. Derivatives are essential tools for managing risk in our incredibly complex global economy. So the question isn't whether we should use them, it's how. How do we keep wielding the shield without getting cut by the sword? That is still the central challenge.